Over the last several days, something really interesting has been happening in the silver market. It's not the kind of thing that makes big headlines with massive price swings, but it's a subtle, powerful dynamic unfolding just beneath the surface. It all comes down to how certain silver-related stocks have been behaving, especially when specific market mechanics met a very important deadline. These are the moments that often fly under the radar, not because they're insignificant, but because they're not obvious at first glance. During this time, the price of silver itself was actually pretty stable. There was no wild ride, no chaotic trading. It looked calm, but under that calm surface, a major divergence was starting to form. What does that mean? It means the stock prices of silver mining companies whose profits are directly tied to the price of silver, started to take off. And they were accelerating at a pace that was much, much faster than the movement in the price of silver itself. Now, divergences like this don't just happen randomly. They usually signal that something bigger is at play, involving things like market positioning, leverage, and time-sensitive deadlines. To really get why this is so important, we need to step back from just looking at the price chart and think about the market's overall structure. This whole period lined up perfectly with the monthly options. Expiration. For those who might not know, this is a regular event where a huge number of derivative contracts either get settled or expire. Options? Expiration is a big deal, not because of wild speculation, but because it forces theoretical risk to become real. All that risk that just existed on paper suddenly has to be dealt with. People have to adjust their positions, hedge their bets, or neutralize their exposure. It's a moment of truth for the market. Early in that expiration session, we saw a sharp, quick drop in the price of silver. The price was pushed down pretty fast in a short amount of time. Moves like this are actually quite common around expiration. It's often a way for big players to shake things out, test how much selling the market can handle, and maybe even try to influence where the price settles. For a little while, it looked like this downward push had worked. The price stabilized near a level where a lot of options contracts were clustered. But here's where it got really interesting. The key wasn't the initial drop, but what happened next. Instead of continuing to fall, the price just stopped. It stalled. In financial markets, a stall near a widely watched level can be more telling than a rapid move. It's a sign that the sellers are meeting strong resistance. It suggests that longer-term players, the ones with a bigger view, are stepping in and starting to buy up all the silver that's being sold. They're absorbing the supply. As the trading session went on, this buying activity became more and more obvious. We weren't just seeing a bunch of small, fragmented trades anymore. Instead, we started to see larger blocks of silver being traded. This is a clear signal that bigger institutions are getting involved, entities that can buy in significant size without being spooked by tiny, short-term price fluctuations. They have a different strategy. By the end of the day, silver had completely recovered all of its earlier losses. Not only that, but it settled above a very important technical level. This had major mechanical implications for the market. Why? Because certain options contracts that were expected to expire worthless with no value were suddenly in the money. And when options finish in the money, it automatically changes everything. Hedging requirements shift based on complex formulas and risk models. It's not about a dramatic story, it's about a cold, hard accounting reality that forces action. So, while the price of physical silver was putting up this quiet fight, the real action was happening in the silver stocks, or equities. These stocks weren't just rising a little bit, they were exploding higher. We're talking about gains of 10, 15, even 20% or more in a single day, while the metal itself was up maybe 1 or 2%. This kind of extreme outperformance is a huge red flag. It tells us that the smart money is not just buying silver, they were making highly leveraged bets on a future rise in silver prices. Buying shares of a mining company is like making a leveraged play on the commodity itself, because a small increase in the silver price can lead to a much larger increase in the company's profits. This intense buying in silver stocks suggests that some market participants were caught off guard. They might have been shorting these stocks, betting that they would go down. When silver refused to stay down and instead rallied back, these short sellers found themselves in a very difficult position. They were forced to buy back the shares they had borrowed and sold, and this rush to buy creates a short squeeze, which sends the stock prices flying even higher. The options expiration acted as the trigger, the deadline that forced their hand. What we witnessed was a classic example of how pressure can build up silently in a market. It's like a coiled spring. The price of silver itself was held down, but the energy was being released through the equities. This tells us that there's a powerful underlying demand for silver that is not being fully reflected in the spot price just yet. Market participants who want exposure are finding other ways to get it, and they're doing it with urgency. Think of it this way. The market was trying to push silver down to keep it under control, but the foundation was too strong. The buyers absorbed all the selling pressure, and when the sellers couldn't break through, the momentum shifted dramatically. The fact that this all culminated on options expiration day is no coincidence. It was the catalyst that forced all the hidden tensions out into the open. So, what does this mean for the future of silver? This type of event, this divergence between the metal and the miners, is often a very reliable leading indicator. It suggests that a significant move in the price of silver itself might be on the horizon. The market is sending a signal that the path of least resistance is now to the upside. The pressure that was holding the price down is weakening, and the buying pressure is building up serious momentum. It's a fascinating dynamic to watch. It's not about the daily noise or the chatter. It's about understanding the deeper mechanics of the market, the plumbing, the structure, the things that happen behind the scenes. The behavior of the silver equities is screaming that something has fundamentally shifted. The market fought a quiet but decisive battle, and the bulls seem to have won a key victory. Now, we watch to see if this energy in the stocks will translate into a powerful new trend for silver itself. The stage certainly seems to be set. Thanks for watching today. If you found this breakdown of the silver market helpful, make sure to hit that like button and subscribe for more in-depth analysis. We'll be keeping a close eye on this, so you won't want to miss our next update. See you in the next video. Hey everyone, and welcome back to the channel. Today, we're diving into a fascinating puzzle that's been playing out in the financial markets. Why did silver mining stocks suddenly explode, leaving the price of silver itself in the dust? It's a classic case of the tail wagging the dog, and we're going to unpack the mechanics behind this move. Let's set the scene. Recently, we saw a situation where silver, the metal, posted only a modest gain. But if you looked at silver-related stocks, the companies that actually dig the stuff out of the ground, it was a completely different story. Some baskets of silver mining stocks rallied several times more than the metal. We're talking about a huge gap in performance. So, what gives? Historically, when you see this kind of massive outperformance in equities compared to the underlying commodity, it often points to one thing: leverage. Specifically, it suggests that the leverage built into these stocks is being activated. This can happen for a couple of reasons. First, the market might be rapidly changing its expectations about how much money these companies will make in the future. Second, and more importantly for our story today, it can be linked to hedging activities tied to financial derivatives. This second point is where things get really interesting. It leads us into the world of options trading. Think of it like this. Options are contracts that give someone the right, but not the obligation, to buy or sell an asset at a predetermined price known as the strike price before a certain date. When the price of an asset, like silver, is really far away from an option's strike price, that option isn't very sensitive to small price changes. It's considered out of the money. For the people who sell these options, usually big financial institutions, they don't need to hedge their position very aggressively. Their risk is low, so they can keep their hedging light. But everything changes when the price of silver starts moving closer to, or even past, that strike price. Suddenly, the option sensitivity, what traders call delta, shoots up. The risk for the option seller increases dramatically. To manage this new risk and stay neutral, they have to act. What do? They often have to buy the underlying asset or something closely related to it, like silver mining stocks. This isn't a discretionary decision. It's not some fund manager thinking, I feel bullish today. It's a mechanical, almost automatic response driven by risk management models. Their computers are telling them, your exposure has changed. You must buy now to rebalance. Now, imagine this happening across the market. If there's a large concentration of options contracts all clustered around a similar strike price, and silver's price breaks through that level, you get a synchronized wave of buying. It looks like a coordinated move, but it's really just thousands of independent actors all responding to the same trigger at the same time. This can create a powerful feedback loop. The price moves up, triggering hedging, which involves buying, which pushes the price up further, triggering even more hedging. This is what we call a gamma squeeze. So why did this powerful force hit the stock so much harder than the metal itself? This is where another type of leverage comes into play, operating leverage. A mining company is a business with enormous fixed costs. Think about the massive machinery, the labor force, the permits, and all the maintenance. These costs don't change day to day, whether the price of silver is up or down. When the price of silver rises, those fixed costs stay the same, at least in the short term. This means that every extra dollar from the higher silver price flows almost directly to the company's profit margin. A small increase in the silver price can lead to a much larger percentage increase in profits. This is operating leverage in action, and it makes mining stocks incredibly sensitive to changes in commodity prices. So, when that wave of mechanical buying from options hedging hit the market, traders had a choice: buy physical silver or buy the highly leveraged mining stocks. The stocks offered more bang for their buck, a more amplified way to gain exposure to the rising silver price. The buying pressure, therefore, became concentrated in the equities, causing them to surge. Of course, it's important to remember that leverage is a double-edged sword. Just as operating leverage can magnify gains when prices are rising, it can crush profits and stock prices when the commodity price falls. Those high fixed costs still need to be paid, even if revenue is dropping. We also need to be intellectually honest and consider other possibilities. Equity markets are complex beasts. This outperformance could have been influenced by other factors. Maybe there was a broader shift in investor sentiment towards riskier assets, or perhaps money was rotating out of one sector and into mining. Changes in macroeconomic data, or new expectations about taxes or regulations in the mining industry could also play a part. Sometimes, a short-term burst of strength is just market repositioning that has nothing to do with derivatives. History is filled with examples of these explosive moves fizzling out once the mechanical buying pressure subsides. But in this specific case, the evidence strongly points to a mechanical trigger. The timing was crucial. The event happened right around options expiration, which compresses all of this hedging activity into a very short window. In a market with uneven liquidity, where it might be easier to buy stocks than large amounts of physical silver quickly, the adjustments get funneled into the path of least resistance. That path led directly to silver mining stocks. So, to sum it all up, a move in the price of silver triggered a mechanical hedging response from option sellers. This buying pressure was amplified by the inherent operating leverage of mining companies, causing their stocks to dramatically outperform the metal itself. While other factors might have contributed, the synchronized timing and the sheer scale of the move strongly suggest a derivatives-driven event. It's a perfect example of how the intricate plumbing of our financial markets can create powerful and sometimes startling effects. Thanks for sticking with me through that deep dive. It's a complex topic, but understanding these mechanics is key to making sense of the markets. If you found this explanation helpful, please hit that like button and be sure to subscribe for more content just like this. Let me know your thoughts in the comments below. See you in the next video. So, where do we go from here? The big question now is whether this recent move in silver has legs or if it's just a flash in the pan. The immediate focus is on those key price levels we've been watching. If silver can hold its ground above those support lines, and if mining stocks continue to show that outsized strength, it's a strong signal that this adjustment isn't over. It suggests there's still more room for this repricing to play out. But we have to be realistic. If silver prices slip back below those critical thresholds, this whole setup could unwind just as fast as it appeared. The same mechanics that propelled it upward can work in reverse, and that's a risk we can't ignore. Adding another layer of complexity, we have earnings season right around the corner. This is where the rubber meets the road for mining companies. Think about it. For these miners, a lot of their costs are relatively fixed in the short term. So when the price of silver they sell goes up, that extra revenue can flow directly to their bottom line, leading to some serious margin expansion. This is the moment of truth. All the assumptions and expectations that have been baked into their stock prices get tested against hard numbers. Sometimes the earnings reports will confirm the market's optimism and pour fuel on the fire. Other times, they can throw a bucket of cold water on the whole thing. We also have to consider the other side of the coin, rising costs. It's not just about the price of silver going up. Miners are dealing with higher expenses for energy, labor, and increasing regulatory compliance. These rising input costs can eat into those potential profits and offset some of the benefits from higher silver prices. This adds a significant layer of uncertainty to the earnings picture. Will the boost from silver prices be enough to outweigh the drag from higher costs? That's the billion-dollar question that will be answered when those quarterly reports come out. One thing you always have to remember about markets is that they are forward-looking. Prices don't just reflect what's happening today, they reflect what investors expect to happen in the future. They're trying to price in future cash flows, future earnings, and future economic conditions. This is the central challenge for everyone involved right now. Are we witnessing a short-lived technical price adjustment? Or are we in the early innings of a much larger, more sustained revaluation of silver and the companies that mine it? Telling the difference between the two is what separates successful investors from the crowd. To get a clearer picture, we can't just look at the price on our screens. We need to dig deeper into the physical market. I'm talking about things like the premiums being paid for physical silver coins and bars, the inventory levels at major exchanges like the COMEX, and the flow of metal being delivered. These are the real-world indicators that can tell us if there's actual tightness or friction in the supply chain. Now, high premiums and falling inventories don't automatically guarantee higher prices, but they are crucial clues. They tell us that the market is feeling the strain. Of course, markets are adaptable. If prices get too high, demand might fall, people might start recycling more silver, or industries might look for cheaper substitutes. But these physical signals give us a vital piece of the puzzle. And let's not forget the human element, the psychology of the market. When you see a big, sharp price move like we've just had, it grabs headlines. The financial media starts talking about it 24/7, and that attracts a whole new wave of participants. These new players often have different goals, different time horizons, and different levels of risk tolerance. On one hand, this can bring in more liquidity, which is generally a good thing, but it also tends to crank up the volatility. What might have started as a purely technical, mechanical adjustment can quickly morph into a much broader, narrative-driven story about silver's true value. The story starts to take on a life of its own, but even with all this noise, the core structural variables haven't really changed. It still comes down to where the price is trading relative to those past resistance levels, how those leveraged silver mining stocks are behaving, and how the market as a whole reacts to new information, like the upcoming earnings reports. In the days and weeks after a big move, you often see the market go into a testing phase. You'll see attempts to push prices back down. If those attempts fail and the price finds solid support, it's a sign of underlying strength and resilience. It tells you that buyers are still there, ready to step in. But if support breaks decisively, it suggests the initial buying frenzy has run out of steam. Right now, that's exactly where we are, in the middle of that testing phase. It's a fascinating moment. You have some investors who are taking profits and reducing their exposure. You have others who are sitting on the sidelines, waiting for more confirmation before they jump in. And then you have another group who are betting that the price has gone too far, too fast, and is due for a pullback. They're betting on a reversion to the mean. How this all resolves will depend on which of these competing forces wins out. Ultimately, the true significance of this recent surge in silver won't be judged by the size of that initial spike. It will be determined by what happens next. Do the gains consolidate, forming a new, higher base? Do they extend even further as new buyers come in? Or do they retrace, giving back all the ground that was just won? The final verdict is still out. We're watching a dynamic situation unfold in real time as earnings, cost pressures, physical demand signals, and investor positioning all continue to interact and shape the path forward for silver. It's going to be a fascinating story to watch. Thanks so much for tuning in, and make sure you're subscribed so you don't miss our next update on this developing situation.